Okay, now we are going to look at the another two methods of valuation. So we understood dividend discount. Now that one is just only for usually the individual investor perspective. When you are an individual investor and you are going to invest into the stock, so what you are expecting is only a dividend, right? And that's why you can evaluate only the share prices from that perspective only, the dividend that you are getting and also the future selling price or future repurchase price that you would be getting from the company at the end of 1 year or at the end of 5 years or whatever, right? Then there are perspective from the investor who are not just only investing the money for dividend only, right? They own the business, so they are going to own the business. So in that case, we value the price of the stock based on the entire cash flow of the company that the company is able to generate, not just that they are going to pay to the shareholder. So in that case, we come up with the discounted free cash flow model. Now, this model means that the value of the company would be equivalent to the total value of cash flow that they are going to generate in the future, divided by the shares that there are outstanding at any point of time, right? So the discounted free cash flow model focus on the free cash flows to all the investors, right? Not just only one investor, but all the firm's investor, whether it's the shareholders, whether it's the preference shareholders, whether it's the long-term debenture debt holders, or both equity and the debt shareholders. After that, it will take it as a value of the company itself, right? You will minus the interest to go to the debt shareholder, and whatever left is for the equity shareholders. So you will value the equity shareholders based on that thing. So the formula for calculating the dividend discounted free cash flow model is the EBIT, earning before interest and taxes, 1 minus the tax rate. So because you still need to pay the tax to the government, so basically this phrase EBIT into 1 minus tax rate will become earning before interest after tax, but after taxes, okay, plus the depreciation, because normally is included, minus the capital expenditure and minus the increase in the working capital, how we add the depreciation and how we adjust the increase or decrease in the net working capital, and minus the capital expenditure. So that becomes the firm's cash flow. Based on this firm's cash flow, we will discount this at certain rate to become the market value of the firm. That market value of the firm is equal to the market value of debt plus market value of equity shareholders, right? So that is will be the enterprise value equals to market value of the equity plus the debt minus the cash. So both should be equal, and then we will just minus the value of debt from the total enterprise value, and we get the value of equity shareholders, and then we will be we can get per share price easily, right? So that's the one perspective. So this is the second perspective of doing the valuation. The first perspective that we discussed in the last chapter was individual investor. Here we are talking about the firm's value, overall company value, right? So the discounted free cash flow model is if V is the present value of the value equals to the present value of cash flow to the firm, right? So that is the formula. So price of one share will be value plus cash, the cash that is holding in the company, minus the debt amount, which is the value to the debt shareholders, divide by the total number of shares outstanding. So that will give you the real price of the company. We are not thinking about the discount dividends or when we are going to get the dividend or the future market value of the company, but here the biggest challenge will be to estimate the free cash flow to the firm. Cash, you know, is on the balance sheet. Debt, you know, it's on the balance sheet, right? The value share outstanding is it's on the balance sheet. Now the V is calculated by present value of future cash flow to the firm. So the only uncertainty in this formula is really the expected future business. As like Sampath was asking last time, how do we value the company, if its value is worth to invest or not? So based on the past financial information and the companies pastel analysis and companies management disclosure, that how much would be what is the future of the company. Analysts usually create the financial models and to see what would be the estimated financial cash flow or free cash flow to the company, and then they take the present value at certain rates. Now the rate comes usually from the similar companies. So now we know the rate. Now the only thing the analyst will need to do is estimate the free cash flow, use the discounting ways to get the present value. That will give them the market value plus debt plus cash minus debt divided by shares. So that will give them an understanding of this is the fundamentally market price of the company. Now if the real market price is lower than this because of any sentiments or anything, we will see how that is happening, then they will buy. If it's more, they will not do anything. They will just wait for the share price to come down, because there are hypotheses or there are general theories that the share price of the companies will come back to the realistic price based on these discounted cash flow model that we are running, because at some point of time everybody will know about the information, and they will discount those factors into their understanding, and they will not overpay, and they will buy if the price is cheaper than the market value, right? So that's the concept of discounted free cash flow model. When the parent company invests into a subsidiary, they will not do the valuation because they are the same. As there's normally they don't do the valuation of the subsidiary companies. So let's say they have invested a certain amount in the company at certain value, right? In the future, when the market value of the company is increasing or decreasing, they have to adjust the profit or loss. If let's say the company is listed, you don't need to do this exercise because the share market price will automatically tell you, right? But if let's say the company is not listed, then you have to use this way of calculating the market price, the value of the company, and then see is it your investment is still the same or not. By prudence, you cannot book the profit. Means if the value is more than your investment, you will not book the profit. But if it's less, you will have to book the loss, because that's the prudent accounting says. You have to record your losses. You may not record your gains, but you have to record your losses immediately. So the formula is very simple. Free cash flow divided by here we are using RWACC. If you focus on the formula, it says the RWACC means a weighted average cost of capital for R. We will learn that weighted average cost of capital in the next slide, not in this one, but we will just assume the number first. So to implement the model, we need to calculate the weighted average cost of capital, which we will learn how to calculate in the future, and forecast the free cash flows up to the some horizon. After that, you can calculate a terminal value, means you fix the free cash flow, and then you assume that this is going to be the constant growth model. Like in the dividend discount model, we calculate after this it will be constantly growing for let's say a 2 percentage point or 3.3%, and then you will calculate a value based on that. So you will get a value, and then again you have to discount that because that's in the future. So you made it decide whenever you will take that. So we will look at the example to understand it more. The free cash flow model is free cash flow of the next year, means the coming year, divided by the R minus the G. So that's the simple formula that you will have to use when you are calculating the terminal value, which is used in this formula. Free cash flow divided by 1 plus R n, FCF n divided by 1 plus Rn plus the terminal value. So let's look at the example. So let's say they had a sale of $25 billion in 2012. Suppose we expect the sales to grow at 10% in 2013, but then slow by 1% per year to long-term run growth rate that is characteristic of the apparel industry, i.e. 5% by 2018. So now we can start to create the Excel file. So you can have one sales which is $25.3 billion, then you increase the sales by 10%, then 9%, then 8%, then 6%, then 5% by 2018. And then based on the profitability, you can say that EBIT is 10% to the sales. There is an increase in the working capital requirement to be 10% of any increase in the sales. And then if they had total sale of $3 billion, total cash of $3 billion in their hand, $1.2 billion in debt, 893.6 million shares which are outstanding, tax rate is 24%, and weighted average cost of capital is 10%. What would be the estimated value of Nike in early 2013? So that's the question. So in this case, the first we need to identify is the firm's cash flow, and then we will grow them until a constant rate, and there we will get the market value of the company, and then we will add the cash and reduce the debt and divide by the number of outstanding share to get a per price, right? So in this case, sales in 2012, as you can see, is $25.3 billion. Then in 2003, it will increase by 10%, 14 increase by 9, 15 increase by 8, 7, 6, and 5 in 2018, right? So the growth. EBIT is 10% of the sales. So means your earning before interest and taxes is 10%. So 2783, then based on the sale that you are getting, you will get the EBIT. You have to pay the income tax. So, and also we need to reduce the increase in the net working capital, which is 10% of the incremental sales. So incremental sales only, not a total sales. So if the incremental sale is 27.8 minus 25.3, multiply by 10%. So whatever sales is increasing, the net working capital also increased by another 10%. So it's not the every total all the increase is coming to our pocket. Since we don't have the information on depreciation and capital expenditure, we leave them as it is. So now by this way you get the free cash flows. Now based on these free cash flows, you will need to calculate the also a terminal value based on 2018. So based on 2779, so 2019, the first thing it will happen is it will grow by 5% first, and then you will discount them to the value of R minus G. So that becomes $58 billion. Now we can put everything into the formula, which is all the free cash flows here, 1.10, 1.10, 2, 3, 4, 5, 6, and the terminal value. So the total value we get here is $42 billion, right? Based on that, we get the market value of the company plus the cash value minus the debt divided by the total number of shares which are outstanding, 893.6. So the per share we are getting at $50 per share, right? If you remember, the share price in the market is about $60. We saw in the previous slide, in the first thing that we saw, right? So the market value is 60, but the actual value of the company based on the analysis is $50. So in this particular case is lower, right? So the people who are now getting understanding of who are sharing the same view that it will increase only by 10% or 5% in the future, and the risk is 10%, they will sell their shares because they know that in the future the company's share price will reduce as soon as the information is coming in the public. Those who feel that no, it's not going to increase by 5% only, it will increase by maybe 10% or continue to grow higher rates, then for them the value may be higher, so they will continue to buy the shares. So this is how the share market reacts. Let's say what happens is the sale is there, right? But you may have some debtors, correct? Now the debtors don't go into the profit and loss statement, they go into the balance sheet, right? Let's say you are making a margin of 30-day sales outstanding, that's your maximum, right? You don't in any ways you are not going to accept anything less than that. So if 30-day outstanding, how much would be your debtors at $25 billion? Can you calculate? The way to calculate is 25,300 divided by 365 into 30 days, right? 2079. Now next year the sales increase to 27,830, and we assume the same 30-day credit, right? So how much would be the debtors now? Because the sales has increased, so 27,830 divided by 365 into 30, right? So it will increase, maybe it's more than 2000. I don't know how. Can you see how much is it? 27,830 divided by 365. So it increased by 200, right? So but this amount is not going into profit and loss because the entire 27 million has been into the profit and loss statement. But actually we are not able to collect everything. If we are able to collect everything, all the incremental sale, then the debtor should have remain at 2000, right? but it has increased from 2000 to 2200. So that's why we have to remove the increase in the net working capital, because which is these 2000 to 2200 from the cash flow, because with the increase in the sales, your inventory may increase, your debtors may increase, your other advances or anything else which you need the capital to run the company may also increase, right? But those things are not going into the profit and loss statement. That's why we have to remove them separately. This is quite important for you to understand, and how we are compiling the information, and how, because you are not finance expert, so it will be difficult for you to remember that it's EBIT minus the taxes plus the depreciation minus the capital expenditure and minus the net working capital. So if you are not sure on anything, you can ask. Okay, well, the formula to calculate this is to look at basically the way to calculate this 58 is, because we know after 2018 our income will become fixed, gonna constantly increasing at 5%, right? Since in 2018 we are earning 2779, our cash flow is 2779, right? So what we are doing is, now we want to calculate the end of 2019, the value at the end of 2019, which is going to be the cash flow of 2019 onwards, right? So in 2019 our cash flow is going to be increased by 5% again anyway, right? So that's why we multiply by 1.05. So that's why we get the cash flow of 2019. So if we want to get the value in 2019, we need to get the free cash flow of 2019, but we don't have 2019, we have only 2018. So that's why we calculate FCF of 2019, multiply by the growth rate, then whatever amount we get, 2779 into 1.05, we need to divide that by the R minus G. So which is R is 10% and G is 5%. Growth is 5%. Constant growth is 5%, right? So if you solve this, you will get $58,367 million, because it's a constant growth. So that's how you get, but this is the value you will get at the end of 2018. For example, I am the investor. So I am going to use this information to negotiate with the company that, hey, your actual value is only $50, even though the market is 60. I will not buy at 60. I will buy at 50 or less than 50, because that's how I see. I will do the evaluation and say, okay, this is your maximum price. I mean, I will not even show them this, right? Because as an investor, I will do my adjustment and will say, okay, I can offer you only $50. Now, if let's say I am Nike and I receive an offer of $50 per share, i.e. a valuation of total $42 billion, right? That's the value that I'm getting. I will say, oh, actually I will also run my own assumptions then. So in that case, it may be similar or it can be different. If I get lower, I will not sell my company. If I get a lower value doing the similar exercise, then I will sell my company and say I'm getting a more value now and let me sell it out. But if I am getting a more value, then I will not sell the company. That is from the selling buying perspective. Now when it comes to the company operations, this has nothing to do with the operations actually, because what we are doing here is we are just estimating the future value of the company. If Nike says, yeah, based on the total evaluation, the share price, actual share price is supposed to be only 50, but in the market it's $60, maybe because of some sentiments, and the news will go out very soon. In our balance sheet, when we are setting up our annual reports, let's make some plans so that the people get inclined to overvalue, right? Means they will say, oh, we have a lot of sales, or our growth will be much higher than what actually is, if they want to retain the $60 value. Because how you are getting this? Basically, you are getting this information from where? From you are estimating a sales increase. You are estimating it maybe from the normal general industry, or what you have learned from their management report, or from their plans, right? So you will try to adjust, oh, how much sales will grow for Nike based on their market plan. So if let's say they have no market plan, means their growth will run only 5%. If they continue to have some initiatives, new plans, then they may continue to get more than the market value. Their growth will be more than the market. So obviously their share price will also be more than the market, right? So sometimes the executive, they who want to increase the share value of their company, they continue to come up with the new plans, new devices, so that the general market or the financial analyst, they keep on thinking that okay, the value of this company is going to increase because of whatever plan they are making, right? It is going to be used in as a negotiation tool between buying and selling. So both parties will do their own version. So it's not going to be the same. Nike may say, oh, actually it's not 5%. I will have future plans. I will do this. I will do that. I will continue to grow at 10% throughout the whole year, right? They can say like this. So in that case, their value will not be 9%, 8%, 7%, or 5%. Their value will be increased by 10, continue to increase by 10%. In that case, their value will be super high, right? And so that may be their version. The other version who want to buy, they will do a conservative evaluation and say, okay, what is the maximum increase in the revenue? So they will value the company at that point. So to maximize the share price, you should accept the projects that have positive NPVs. Means the future cash flow will continue to increase. That's why that's how it is linked to the capability. The present value of the cash is higher than is positive. Whatever is plus will continue to increase the share value of your company. So that's why to continuously increase the share value of the company, executives keep on coming with the plans, the growth plans, a new product launch, a new factory, a new brand, or new whatever costs efficiency. They have to show the plans so that present value of those plans is added to the market value of the company. At any given point, whenever the company announce any project, the financial analyst will look at the details and say, okay, the company has this plan, means they will increase their net present value in the future by this amount. Let's add into the net cash flow and adjust the price. So next time when they are selling, they will already add that project. So the selling price will already be included, even if the company has not really implemented the project yet. And that sometimes is the gap between the individual investor, because they come to know, let's say a company announce a new factory, right? But the company will announce it first into the stock exchange, and if you are not reading the news on a daily basis, you may come to know about this maybe 2 months later or 3 months later. By the time the value of this news, means the value of this project, is already added into the stock exchange, is already added into the price which is on trading, right? So that's why the price keep on increasing or decreasing. The price increase because of the future prospects, because of the new orders. If you are following the stock exchange, you will realize whenever there is news of new product launch, whenever there is a news of new policy which will help the company to keep higher cash in their pockets, their share price increase. And the reverse is also true. Whenever there is a crisis and the things that in the future company's cash flow will drop, their price immediately drops, right? So that happens in the real time. Whenever the information is out in the public, it is reflected. So if you are late, means by you're not reading the news, you're not on top of everything, you are making a decision after 1 month, you are already late. If you factor those old news again, you will be losing the money, or you will be losing the value of your own investment. So the process is you need to forecast all the inputs to the free cash flow. You can add more details. They are still only based on assumptions because you are dealing with the future, right? So you have to get a sensitivity analysis to say, okay, what is the sensitivity? To give you an example of the sensitivity, let's say the EBIT was assumed at 10%. What if they are able to reduce the operating expense and say now our EBITDA will be 11%? What would be the change in the stock price? So you now have to recalculate 1% increase in the EBITDA. What would be the difference, and discount it by the tax and see what is the value. So this is the difference. If the free cash flow will change to 2073, 2027, 2287, 2896 and 3075. Based on that also the terminal value will change as well, right? Terminal value previously was 58, now is $65 billion. and if you do the calculations again, the total value will increase from 40 to 43 to 47 billion dollar. So 1% increase in the profitability or in the operating expense will increase the value by another 10%. So the previous price was 50%. Now the new price will come to 55%, right? So there's a difference of about 10%. 1% decrease in the operating expenses will increase the value of the share by 10%. And the same goes true if the operating expenses increase by 1%, i.e. the profitability drop by 1%, the share price will also drop by 10%. So that's how you look at it. Now in this example, we are looking only at operating expense. We could play with the growth assumption. What if the future cash flow increased by only 4% or only 5%, or what about 6%, what about 7%, right? And then you will see, okay, what is the difference in the calculations, what is the impact on the price. So there you can make the adjustments to your strategy as well, right? So it's a comparison of discounted cash flow model for stock valuation. So it's a present value of dividend determines the stock price, right? The total payout, all dividend and repurchases determine the equity value, and the present value of free cash flows determine the enterprise value itself. But in that case, you have to adjust the debt and also the cash and divide by the equity shareholders. So that's how the value comes at, what adjustment you need to do to get the stock price. So that's the one method. Now there's a third method that we are now going to discuss to get the share prices valuation, is the valuation based on comparable firms. Now this is very, very simple and easy to implement. There's not complicated formula. There's no complicated formula here. So it's another valuation principle. We normally estimate the value of firm based on value of another company. So for that, we need to know the another company value first, right? Then we say, okay, we can relate how these two firms are connected to each other. So let me give you an example. Consider there is a new firm which is identical to existing publicly traded firm, right? So the valuation principle says that if they have similar cash flows, if they have similar size, if they have similar risk, they will have same price, right? So it says like the two chocolates which are taste the same, which are having same weight, which are having same color, will have the same price, right? That's a valuation principle. So two companies which have similar cash flows, similar everything, is gonna be having the same price, which you will see if you discount their free cash flows with their rate of capital will be the same, right? It's a hard fact. So if these firms are identical, then means we can use the market value of one company to understand the market value of another company. So what we do is we just adjust the difference in the scale using the valuation multiple. So the valuation multiples means is the ratio of firm's value to something else, and what that is, it can be price to earning ratio, which we explained in the past. What is the total value, what is the price of this new with the company, the benchmark company in the market, and what is their earnings. There can be enterprise value multiples. What is the total enterprise value of the company compared to the sales, compared to the profit, compares to the asset, compares to many things. On there are other multiples like per person, per employee, per asset. What is it? So if multiples of sales, multiple price value to the book of equity. There are industry specific ratios as well. So some of the like new technology companies, they are basing their valuation on the customers acquired, the customer base, how many customers they have. If you buy a Facebook account, what is the multiple that you will use? How many followers they have, right? An e-commerce business, you will say how many transactions they are doing. What is the value based on how many transactions they process every year, right? And maybe a ticketing airline company, maybe how many tickets they sell. Cinema, maybe how many people are coming to watch their movies. So that's the way how we multiply. So there can be multiple multiplications which you can use for multiplying, right? So the most common valuation multiple is usually the share price divided by the earning ratio. So that's the most common use, price to earning ratio. So let's look at the example just to make it easier for you to understand and how price earning ratio works. Suppose there is a furniture manufacturer, Herman Miller. They have a earning per share of 138 and average PE ratio of comparable furniture stock is 21.3, means price to earning. So what would be the price of Herman Miller? So we know the PE 21.3, we know the earning 1.38, we just need to know the price. So how will the price will come? Price will be PE ratio multiplied by the earnings per share. So that will become 21.3 multiplied by 1.38. So that will become the price value of Herman and Miller. What is the assumption? The assumption here is that Herman Miller has the same future risk, same payout ratio, same growth rates as the other comparable firms in the industry. Payout ratio and growth rate maybe can be the same comparable industry because the industry remains the same, but what makes the company different from them is can be the patents, can be the long-term contracts, can be a free land, can be designers, can be the quality of the management, right? When in real life we are using these formulas, we may have to look at the benchmarks and say, okay, how we are different, and then we adjust the multiple ratios. I mean, let's say you get this value, initial value, then you have to adjust upwards and downwards depending on what are your advantages compared to the benchmark. So if you are better off, let's say you have a better terms, whether you have better employees, whether you have better contracts, whether you have government favoritism or anything else, then it means that you are going to get the benefits, right? Normally the PE ratio is based on the two things. One is trailing earnings, one is forward earnings. So what is the meaning of trailing earnings? Trailing earning is your past earnings, right? And the forward earning means what do you think is your future going to be? So PE ratios are related to the other valuation techniques. In case of constant dividend growths, we had this way, right? So it's the same thing. We divided through the EPS, you will get the forward price to earning ratio, P divided by EPS of 1, dividend payout ratio divided by the R minus G. So there is a link between the other formula that we have used already and also the price to earning ratio as well. So let's say Amazon and Macy are retailers, both are retailers. In 2016, Amazon had a price of $700 and a forward earning per share of 9.78, right? Macy had a price of $31 and a forward earning per share of 3.77. Calculate their forward PE ratios and explain the difference. If you have calculated their forward PE will come to 73 and 8. Now the Amazon's PE ratio is higher because maybe they expect that the Amazon's earnings are going to grow much faster than what Macy's earning per ratio is going to grow in the future. So that's the difference. That's why they are different. Now the question is, why is there difference? Both are retailers. Because maybe the people think that Amazon will grow their earning per share super fast compared to Macy's. That's why their price to earning ratio is also much higher than Macy's, right? That's the difference. It means that when you are using the PE ratio for comparing and getting the comparable value, you need to make sure that the both companies have similar growth rates and expect a similar risk as well. If they are not, then even though they may be from the same industry, you cannot use them. So this is another problem. If you want to solve this, also you can solve. Walmart has a $66 and a forward earning per share of 4, means their PE ratio gonna be somewhere average about 15. And Target, the company, has 64 and the forward earning ratio of 5, means their average ratio is somewhere about 12, right? And then you can explain the difference because of the expected earnings are also different. Okay, then there are another one is enterprise value multiples. So there was one is PE multiples, then there is a enterprise value multiples. So enterprise value multiples will make sure that the earnings before the interest are done. because we last time we remember we calculate based on EBIT, not or based on the free cash flows, not based on the net profits. And if the free cash flow growth is constant, then you can also write enterprise value to EBITDA as this: V divide by EBITDA, or you can say free cash flow divided by R minus G divided by EBITDA. That's the valuation, right? Or FCF divided by EBITDA divide by R minus G. So free cash flow ratio to EBITDA divided by growth rates. Let's understand it with the help of example. If let's say Fairview Inc. is an ocean transport company with EBITDA of $50 million, it has a cash of 20 million, debt of 100 million, and $10 million outstanding shares. So if the ocean industry as a whole has an average of enterprise value to EBITDA of 8.5, what is the enterprise value of Fairview and also the corresponding value of the stock price? So the way to calculate would be 8.5 multiplied by the EBITDA, which is 50 million, and then you will add the cash or remove the cash. What will you do? To get the equity shareholder, you will need to add the cash and minus the debt and divide by the 10 million shares. So that's how you will get the enterprise value, and that's how you will get the stock price. So the enterprise value is 50 into 8.5 is 425 million, and then you need to minus the debt plus the cash, that becomes 345 million, which is equity value, divide by 10, so your share price will comes to $34.5. That's how we use the enterprise value multiple. So the other multiples which you can use for using the comparable firms is multiples of sales. So means enterprise value compared to sales. In this example, we multiplied enterprise value with the EBITDA, right? In other examples, you can always use sales, but you need to make sure that the sales margin and the profitability remains same, not gonna change. Price to book value of equity can be used if they have too much of assets, like a substantial amount of assets. Cannot be used for service companies or the companies which are light on asset. Then you have some specific industry like cable TV, enterprise value per subscriber. Technology companies, enterprise value per customer, per contract, per employee, per call center, per branch, for a bank it can be. So that's how the enterprise values are working. So you have to, the only thing you need to make sure is whenever you are using the multiples, it has to be reasonable and it has to be consistent across the with the other industries. If there are significant differences, then you need to adjust those differences. Firms are not identical. The differences in multiple can also be different due to the expected future growth rate, risk, accounting convention between the countries, management skills, ability to market, and all those kind of things, right? So that way it's difficult. And also comparable method is give information only to relative to the other firms in the comparison, but it cannot help to determine if the entire industry is overvalued. Because if let's say the entire industry is overvalued, you are going to overvalue the firm also, right? Because you are taking an average. So for example, internet boom. In the past, the .com companies were very successful. Their share price was super high. The PE ratios were very high. And at one point of time, the .com bubble burst, and every single company on the stock exchange went down, right? So that's the problem with the comparable firms, that it cannot understand if the entire industry is overvalued. So these are the examples of some of the different multiples of different companies in footwear industry. So Nike market capitalization is 55B, Adidas 23B, Puma 4B, Wolverine worldwide is 2.9B, Steve Medal is 2.3, Now enterprise value is different slightly because of the maybe their debt structure, and then their PE ratios. You can look at their different PE ratios. You can look at their price to book, which are also different. Enterprise value to the sales, which is pretty much in line with around $1, $1.2, and then enterprise to EBITDA. If you say here is also $9 to $10 is an average. Nike is an exception. Nike is pretty high. Now, can you imagine why would that happen? Why the Nike has a better price to book, enterprise value to sales, and enterprise value to EBIT at a much higher rate compared to Adidas, but their PE ratio is less? Why would that happen? So it's not that super significantly different. So you can imagine the same thing, but the problem with the Nike is that their price to earning is very less in the market compared to the price to book ratio, which is much higher. Then means they have very less number of assets. Their enterprise value compared to sales is also very high, right? It means their sale is also very low compared to the price that is available in the market, and also the enterprise value to EBIT is also quite high, but the PE is less. Price is determined by in the stock market, right? Price is not determined by the enterprise values, right? The price is determined by the people's sentiment, how they want to pay, what do they see? Do they see a higher growth or do they see a not so higher growth, right? So it means that people see Adidas and Puma as more towards the growth oriented compared to Nike. That's why they are willing to pay a much higher price to Puma compared to their earnings. When you think about the Nike, they are paying less, right? So it means they don't think that the future growth is going to be that much, or the growth in the future is not going to be that much. The price to book, enterprise to sales, and enterprise to EBIT is based on the trailing history at the moment, right? But the price to earning is always the future looking. So when you think about this, then it means the people have lesser confidence in Nike compared to the Adidas and Puma. They are ready to pay a much higher price to them for their stock compared to Nike. But the problem with the valuation methods based on comparable firms, again, as I already explained, they don't take care of difference between firms due to talented managers, manufacturing process, patents, or any other things which gives the company an advantage over the other companies, right? So they are not able to take care of those adjustments. Traditionally, financial analysts who are doing a bit of research on these, they have to adjust by themselves. They have to do the adjustment to the comparable and say if they have a better CEO, they are higher performing staff, the employee loyalty is much higher in those companies, they will add the brand value. So that's why the value of the company will continue to grow, even despite you may not have that much of revenue. Final word on the stock valuation techniques is that there is no single technique which can give you the final answer regarding the stock's true value, because there is nothing. So what the real practitioners do is they combine, they calculate all three, and then they say, okay, if they are consistent, means like a variance of 10-20% among each other, they would do the average. But if they come up with two significant differences, then they would dive into the details and see which method is giving the most accurate method. But there's no 100% accurate method. There is no true value. You cannot determine that because there are so many assumptions, right? Then the other thing, how the information competition and the stock prices are linked, how they are affected to each other. The information in stock prices usually, if a public traded firm, the market price is already provide a very accurate information regarding the true value, because hypothesis, because of our theory that the valuation method we are doing consider all the future value or the prospects of the company and what the shareholders or what the investors are willing to pay. The share value of the company would always be dependent on the future cash flow and the cost of capital. So all the three models that we have discussed, they are giving the share value based on cost of capital and future cash flow in the form of either dividends or in the form of free cash flow, or by comparing the values between the competing firms. Competition, so the efficient market hypothesis is usually implies that the securities are fairly priced based on their future cash flows, given all that investor is available to the investors. Now, how many of you think it's really the truth? Does all the information is available about the future cash flow? The efficient market hypothesis is not true, but it provides the basis for working of these formulas. Otherwise, these formulas won't work. So, and then also there are public easily available information. So information is available to all investors, including the information in news reports, financial statements, press release. The only problem is the timing of this information. Some people's, the information is available immediately to everybody at the same time. The only difference becomes when you are accessing the information, when the users are accessing or looking at the information. They may look at the night, they may look at the day, they may look at the after 1 week or after 2 weeks or maybe even after 1 month, and their ability to understand, right? If they are, let's say, you are not trained in finance, then it will be very difficult for you to analyze the financial statements in detail about the company. So there are two factors. One is the ability to understand, another one is the willingness, means are you really looking at the information or not. So that's the difference, that is, which is going against this efficient market hypothesis, and that what create the difference between the buyer and seller. Let's look at one example. In this example, Myox Labs announced that it's pulling one of the leading drugs from the market, right, owing to the potential side effects of the drug. So for example, Pfizer, right, they made the anti-drugs vaccine, and they say, oh, there are already the bans about around the countries that you are not going to use these shots because of the AstraZeneca, that they are risky. As a result, this future expected cash flow will decline by $85 million per year over the next 10 years. Myox has $50 million outstanding, no debt, no an equity cost of capital is 8. If the news come out in a complete surprise to investor, what would happen? What would be the impact of this Myox stock price? So how would you calculate? You would look at the present value of $85 million for the next 10 years at 8%, divide by the 50 million shares, and then you will know how much of the stock price should reduce immediately after the news come out in the market. So you will calculate that. That will become 576 million or $11 per share. Right? So it means the company's stock will fall by $11 per share immediately. So if, let's say, you I don't know if you follow the markets, I don't follow. So when there are sanctions on the on the cryptocurrencies, on the companies which are going under sanctions, or their drugs are sanctioned by US, by EU, or any other regulations, their future price, their stock price is continuously going up and down depending on what is the news, and that's how you can explain it. The only risk, only challenge here is the estimating what is the loss, right? 10-year, we say now here's $85 million a year loss. How would you quantify that? So you just have to estimate that by getting the information about the company through the internal sources and say, okay, what is the real loss? So you have to estimate by yourself. Private or difficult to interpret information. Now here again, sometimes there are information which is private and difficult. So for example, any pharmaceutical company announce a new drug which is seeking the approval of FDA. Now this is, they are still seeking, right? If they don't get approved, if they approved, they are able to produce, then their market value will increase by 15. The FDA announcement comes as a surprise, right? And let's say the average likelihood of FDA approval is only 10%. Means the FDA can reject also, right? So it means now the investor will say, okay, what are the chances of getting this approval? And then they will increase it based on the probability of what is the FDA approval. Now who will calculate this probability will again depend on the investor, how they think is the FDA average likelihood of FDA to approve the drug. If they are confident, they will bet in all $15. If they think it's 50-50, means they will bet in $7 per share into this news. So the lessons for some of the investors, and so consequences of investor, the investors need to have some competitive advantage. The expertise to access the information is only a few people, lower trading costs than others. If the stocks are fairly priced according to valuation method, then the investor who buys stocks can expect fair compensation for the risk they take. I mean, if the consequences of information for the investors. So there are certain individual biases and trading that you were also asking in the earlier time, that how the price of the stock increase in the stock exchange, right? So there are usually, the one thing is trading is commission based, because you always have to rely on the brokers, and there are usually you may have finding difficulty in finding the over or under valued stock, right? And sometimes the individual behavior is also very difficult, right, at a discount brokerage found. So they are usually trading the overconfidence, right? So sometimes people have overconfident in some shares. Some they get news or tips. Let's say if you believe me as a finance expert and I tell you, oh, Apple is going to grow, you may not want to know the reason. You just say, okay, the Apple will increase, right? Then you will just go and invest into those shares. Those are again some problems with the investors, because they don't really understand. They have their own confidence, or they get the hypothesis from some other tips or the people's, right? Investors also tend to hold on the stocks that have lost value and sell that is high, increasing in the market. If you have done any stock trading, that happens usually. If I see the value of the stock is increasing in the market, means I'm making the profit, you tend to sell it out to make the money, right? And the moment the price decrease, you make a loss, you immediately want to hold it, because you don't want to sell at a loss, right? You want to say, okay, I will hold it, it may increase in the future and I may recover my loss. So you will not sell the share which are reducing, but you may sell the share which are going to increase in the future. Later, after maybe 2 months, you will say the price is not coming down of the share which you already sold, and the price which you hold and were making loss is not increasing. So at that point of time, you will just have no choice, right? Normally people have that tendency. I have that tendency. If I am trading in the market, usually if the price increase, I tend to sell, because I want to make the profit. I don't want the share to go down and my profits are gone. But if the share price go down, I try to keep it as much as I can, because I hope that the price will increase in the future, and so that I can recover my losses. So that's usually a tendency.